my view. First rates, the breath is looking good and promising. Nifty is not doing anything at all. Sensex just like a flat start, a 72,000 index, 59 points here or there. Markets are clearly running out of what could be called as the December end phenomenon. The breadth is looking promising, but it is not looking very charged up. The advanced decline ratio at the start, if you're in a vibrant momentum-driven market, it normally is 1:8 or 1:10. The small cap index is just a shade of green, so to speak. So no large gainers there. I just want to address some of the newsmakers now, some of the big newsmakers. Not too many newsmakers. You want to start with Polycab, you want to look at Bandhan, those are two newsmakers. Then you've got TCS side of numbers, and then next week it will be all about more IT companies, it will be all about private banks. So TCS side of numbers due tomorrow, Infosys side of numbers not going anywhere. Metal stocks across the board are looking strong. And then I want to look at what could be called as the theme-based, mood-based stocks, the UP tourism or the Ayodhya-based stocks, IRCTC, hotel stocks, just about anything and anything which has got to do with more footfalls because of Ram Mandir inauguration. I think that theme, will continue to stay charged up for next couple of days. And that's the way it is. It's a flat start with no particular bias, nothing large in terms of a mover or shaker also.
Let's see what a Polycab is up to. They've denied any rumor of a tax evasion, whether that is seeing any recovery. 2.5% higher for this one. JB Chemicals as well. They're aspiring to be a 50 billion rupees revenue organization by FY27. So look out for that stock. There's of course ONGC, BPCL, IOC, Goldman Sachs has downgraded all three counters to a sell. By the way, Delta Corp also came out with its numbers yesterday, and not surprising that the PAT has fallen 60%. Delta Corp slides further, 5% lower at 144 levels now. There's a Moody's downgrade on Vedanta's ratings as well now, so look out for that stock too. SEBI has kept Ashirvad Microfinance in abeyance, so that's going to impact Manappuram too. So that's another stock that you may want to look out for. And then of course Z, given its exit from the F&O ban list today, Z is actually holding up in the green, 1.5% higher for Z as we speak right now. Kunal, what's looking good to trade considering it's a flat start for the Nifty?
Yeah, flat start for the Nifty, but again a 0.5% downtick for the large cap private sector name HDFC Bank, and that's a short which I've been carrying over the last couple of days. Would want to continue it till at least that stock reaches the levels of 1620, 1625 on the spot level. So expecting at least another 20 points odd correction for the stock. So would want to hold on to the short positions here.
All right, Naresh, let's get a handle as to what you're looking at. Kunal has got a sell on an HDFC Bank. What are you tracking?
So looking at Granules India, that's a stock which has retested the breakout levels. So looks promising at around 410, 412 levels. Could slowly catch up towards 450.
Ashish Gupta joins us. Let's take a conversation forward and understand what he makes of the current market action. Ashish, good morning. Thank you for joining us. The script of how markets moved in 2023 was a function of liquidity, topping out of inflation, and how the corporate cycle picked up, earnings cycle picked up. What do you think will influence the script of 2024?
So thanks for having me today. I think firstly, couple of big headwinds that were there at the start of last year are actually tailwinds for the market, right? So whether we look at flows last year, which were expected to be impacted by the rise in global rates, I think that has turned on its head. Similarly, commodity prices, in particular oil prices, were elevated, and with increasing geopolitical risk, that was a concern for the market, and I think that also has turned into a big tailwind. And while these tailwinds are there, I think some of the factors that drove the market last year are still very much present. We expect the Indian earnings trajectory to remain fairly robust. Even this quarter, we are expecting close to 20% earnings growth to reported by corporate India. And I think this will continue to be the primary driver of the markets.
Okay, while the economy will do well,
yes,
earnings will grow, how much of the good news is in the price? You know, they always say markets look forward. So are markets really looking forward?
Yeah, so I think there is a different level of optimism priced in different pockets of the economy, right? Different pockets of the market. And I think the bigger differentiation that is visible is really the valuation gap that is there now between the large cap and the mid and small caps. Whole of last year, in fact, the large caps actually underperformed the earnings growth they had. And many of the large caps today are cheaper than they were a year ago.
Could you give me an example where small and mid cap stocks have run ahead of themselves and you would say that, look, I will either be a seller or I will not advise anybody to buy them? Give me an example.
So I'll refrain from naming a particular stock, but let me kind of try to address it differently, right? So I think there is quite a bit of optimism that is built into a lot of industrial and capex names. Of course, for good reason, we are still at the early part of uh, the capex cycle, and the trends are very promising. But if you, for example, look at the consumption side of the market, that continues to remain soft. The near-term trends have not been encouraging. Even this quarter, consumption companies are not expected to really accelerate growth. Having said that, many of them have seen the valuations moderate. And in many of these companies, now valuations are very similar to what it is there for the industrial sector. Right? So I think the premium that consumption companies had to industrial companies is contracted significantly, and that's an interesting part of the market now.
But Ashish, to the point that you were making about the optimism in industrials and capex themed stocks, isn't it already priced to perfection?
Yeah, so I think it is priced, and therefore I think more than re-rating, we have to see growth here coming in line with the earnings trajectory. I think what gives us confidence is that we are probably in the second year of an upcycle. Typically, these investment and re-leveraging cycle lasts 7 to 8 years. Right, so we are still in the early part of the cycle, and therefore, I think despite the fact that the stocks have re-rated, we believe there is enough earnings upside over the next few years.
I'd like to draw your attention to themes which, in a sense, are very government-dominated themes: defense, railways.
Sure.
As a fund manager, how would you manage the risk here? There is election volatility. You don't know how things would move in the election and how policy making would change after election. So would you be looking at raising cash? Would you be getting out of some of these so-called PSU names now?
Oh, I think many of these themes are secular. I think some of the changes we have seen in terms of indigenization, etc., I think is not really dependent on just on the election outcomes. And frankly, after the state election results, there is increased confidence on policy continuity. Having said that, I think in some of these companies, one have to be cognizant of the fact that the order book to revenue conversion does not always happen at the pace the market expects, right? So I think that is something which we would be a kind of more circumspect about and calibrated about, rather than really policy continuity.
Track banks with a magnifying glass. Now the consensus view is that, okay, banks is where the growth is, banks is where the visibility is, banks is where the valuations are attractive.
Yes.
But some would say that the reality is different because base effect has kicked in, the war of liability continues, banks will only lend if they have enough deposits, and right now all the fresh savings are moving either into real estate or they are moving into stock markets, and if that was not enough, it is also moving into options trading now. So there is a challenge in terms of new liability which is getting generated, and that could really bring the banking growth down.
I think if you see the banking deposit growth, actually that has picked up from about a year ago, right? So despite what you mentioned, the fact that deposit growth today is happening closer to 13% compared to 18 months ago when it was more than the 10-11% range. And in fact, the deposit growth for banks, yeah, one of the biggest variables itself is the credit creation in the economy. So the credit creation in the economy has remained robust. Deposit growth has also picked up. And I think that will continue to be the case. However, I do agree that base of bank earnings has gone up. Last year, we were probably at some sort of a cyclical high in terms of bank ROA, not just because the margins were elevated, but also because credit costs have been unusually subdued because we were coming from a post-COVID period. And given that, definitely there will be a moderation in ROA for the banking sector in the coming year. Having said that, as you mentioned, banks have underperformed last year, and the markets really did not pay up for the fact that ROAs for the banks improved. And therefore, despite the fact that the return on assets for banks has peaked out and will be moderating, I think the valuations are really comfortable enough for us to be positive on the sector.
Morning. Given the fact that we're surrounded in the city of Mumbai with a lot of infrastructure that's taking place, it is the election year as well. How are you looking at this very capex-oriented theme playing out for the year ahead?
I think it's quite interesting. I think both capex, real estate are sectors that are emerging after multi-years of down cycle. And therefore, the ROE recovery in many of these companies is very, very sharp. As was talked about earlier on the show, some of this has priced in. I think some of this still has to play out. And we are actually still positive on this theme.
Do you see that your fund positioning changing in any meaningful manner in the run-up to the election? Could you be raising cash? Would you be buying puts? How would you hedge the event risk?
So I think firstly, typically we do not try to change fund positioning for particular events. I think yeah, it is really very difficult to predict, and I think we orient our funds to participate in long-term trends. So we really don't position them for particular events. Having said that, I think what has transpired in the last quarter in terms of state election results, I frankly believe this year the bigger risk for the Indian and global markets is going to be election outcomes from the US. I think there's a larger amount of uncertainty relating to that compared to the Indian election.
Lot of market old timers are saying that there is bubble and trouble in small cap stocks at every level, SME, or for that matter micro caps. I look at flows into mutual funds. Amphi data which came I think on Monday, it talks about 20% of the fresh SIP flows is moving into small and mid cap stocks.
Yes.
How do you see that space moving? You know, I understand valuation is a concern there, but a fund manager has a mandate to buy small cap stocks. If you get 3,000-4,000 crores on a monthly basis, the option is to buy them more. So how will this entire space move? Because one side is valuation, second time is flow and sentiment and momentum.
So I think the mutual fund industry is cognizant of the fact that there is increasing valuation differential. The regulator also allows a fair bit of leeway in small and mid cap funds. So, for example, in the large cap funds, mutual funds have to minimum own 80% in large caps. In small and mid caps, you can own only about 65%, and 35% can be non-small cap holdings. And if you look across the industry, I think there are multiple funds where uh, uh, in a small cap fund, the holding of small caps is not maxed out. And in fact, people have actually given the valuation differential, either increasing the cash holding in a small cap fund or increasing the holding of large caps. So I think those are some tools fund managers are using to kind of mitigate the impact of the fact that the flows are getting concentrated into one pocket of the market. Uh, yes, the valuation differential is large, but we also have to recognize the fact that a lot of earnings growth, if you see last year, was really coming in this mid and small cap space, right? So if you look at mid and small caps, their earnings last quarter grew nearly 45% year on year, right? So many of the domestic themes that we talk about, whether it is manufacturing companies, industrial companies, real estate companies, hotel companies, these are represented in the mid and small caps and not really in the large caps, right? So the large caps are typically your banks, a few conglomerates, IT services companies. So the earnings trajectory in the mid and small caps, given the sectors they represent, is also high.
Ashish, great to chat with you today. Thanks as always for taking the time out and joining in.
Okay, thank you.
Okay, let's talk consumption and let's talk about where money can be made and where money has been made. And clearly, Trent is that one stock Milind Karmarkar continues to be positive on. He believes that maintaining price points, robust supply side are the two major factors which are contributing to the success of the company.
The logic by which we had invested continued to hold. So their focus was very clear that they will grow only when they have got their business model right. And their focus was very clear that offer value to the customer and the customer will come in. Like I'll give you an example, like way back in say 2002-3, when Trent was only three stores. And if you would go to a West Side store, in all probability you would get a shirt for a 200 rupees.
Are you wearing a Trent shirt?
Sorry?
Are you wearing a Trent shirt?
No, not today.
Okay.
Not today. Let me clarify.
Okay, you would get the shirt for 199 rupees.
Yeah, at that time.
Okay, this is 2003.
Yeah. Now, that time the India's per capita GDP was about $430.
Yes.
Today we are at about $2,700. If you go to Zudio today, you will still get a shirt, a similar shirt, for 200 rupees. Now the issue there is that yes, maybe that time it was 100% cotton, this will be cotton plus something, but they have been able to maintain the price point, and that's the beauty, because then they have merchandise for every person who enters the shop. So when India's per capita income has moved up from $430 to $2,700, even then they have a price point for someone who may be at $430. So that is the kind of
They've got the
business
customer
model
and the price point and the supply chain right.
and the supply. So I'm coming to that. So supply chain is the key. Price point is also key. And to grow only when you get your business model right. They have done exactly the same thing they did with West Side, and they are doing the same thing with Zudio, and I think they will do the same thing with Star Bazaar as well.
Okay. We're discussing a thought here, and I have just one more follow-up question on the Indian retail industry. The fact that you decided to invest in Trent was also at a time when Future Group was expanding.
Correct.
Reliance Retail got created.
Yes.
Aditya Birla Fashion moved into this acquisition spree.
Yeah.
You decided not to really move to other corporate giants who had the same promise and the same appeal.
Correct.
What gave you the option not to bet on Future Retail or Aditya Birla Fashion or Reliance Retail?
One, of course, was that Trent was betting on private labels, and I knew that private labels have done well globally. That was the first thing. Second was that they had decided to grow without taking any debt, because retail is one of the toughest businesses and with not as high margins as manufacturing. So you need to have your finances absolutely tightly controlled. And that's what they did. And that was the reason why I decided to invest in Trent and not in other companies. Reliance, again, retail, the issue was that it was sitting in another listed company where predominantly it was petroleum.
Okay.
So when I was looking at retail, it was only two, Trent and Titan, which we decided to invest in.
Between 2022 and 2024, it's been 2 years now, have your top 5 holdings changed?
Not really.
Okay, why is that? Because markets are up 50-70%.
They continue to do well. Trend, so it's like this.
What are your top holdings then, just for disclosure purposes?
Trend, ICICI Bank, Titan and Syngene. Okay. 4 I remember, the 5th one I don't remember.
Okay, so top 4 holdings was same in 2022?
Yes.
Okay. I'm not getting into a stock specific conversation, but when you look at a company like Titan, when you invested in Titan, it was a watch company.
Yeah.
Now it is a jewelry company and they're migrating into other businesses. What do you think they've got it right? Because again, the jewelry business in India is highly competitive.
It is highly competitive. But again, so we entered into Titan at that point in time because it had gone into jewelry.
Okay.
So that was one of the main reasons. The second was that, of course, their focus was trust. So they started those machines where you could go and test the purity of gold. Because ultimately buying gold is all about trust. So people buy from a neighborhood jeweler because there is trust. So that is the reason why they could attract a lot of people to their stores. And I think that's what was the main winning factor. And of course, then comes the brand and then comes the designs.
So when stocks, they grow at what could be called as P multiples which are above averages. For example, Trent now is trading at a P multiple of 100 plus. Titan must be 40-50 times 1 year forward depending on the estimate you look at. You don't get the temptation of switching, selling, buying something which is cheap?
So as long as I don't see any business which can grow faster than them, that is one. And frankly, when it comes to Trent, the P multiple, I think one needs to go through the balance sheet. One needs to analyze that because of Ind AS, the changes which have come in, when future liabilities you have to adjust by amortization and interest. So if you adjust for that, it may not be at such a high P. It will still be at a high P, but not as much as 100 plus. So that is one. And second is that as long as they are growing at 40-45%, I don't think there is any problem, because at that rate, the P multiple can collapse if the price remains same, which it doesn't, because if they continue to grow, the price also goes up.
Why do you think Indian pharma sector has a lot of scope for re-rating?
So yes, I think that in future it will be Indian pharma sector which is likely to do very well, because as I think I have said that earlier also, that long back I had met Dr. Reddy of Reddy's laboratory and I had asked him, because that time their focus was exports. I said, why not India? So he said that unless and until India's per capita income grows significantly, where people can start affording medicines, India will be a slow growing business for them. And that's the reason why they are focusing on exports. But now I think things are changing. Our per capita income has gone up. And because of that, I think companies which are focusing on India also should do very well. And that's the reason why I think that overall Indian pharma would be a sector which can be worth looking at.
So should one then look at MNC pharma companies also, because they are a pure bet on India? Because for all other companies, whether they have, whether it is Cipla or Dr. Reddy or for that matter Sun, either they have presence in Europe or in US or in both, and the third one is Africa. So how does one differentiate if one has to bet on the Indian pharma per capita growth?
So I agree with you that companies which are focused predominantly on India should be on your radar. You should look at them. Look at the products in which they are in, because that is very crucial. Ultimately, it's diabetes, cardiovascular. These will be the sort of segments which will do very well in India as the per capita income goes up. So anti-infectives will also do well, but predominantly it will be diabetes and cardiovascular which should do well. So look at those companies and invest in them.
All right, Anil Yadav joins us now, Director IRB. Let's take our conversation forward to understand that toll revenue, which was up 26%. Is this an indication of economic activity and this kind of a robustness? Will it continue? Good morning. Thank you for joining us. Now, the toll revenue was up 26% year on year in December to about 500 crore. Is this largely because of high traffic or new BOT projects?
Thank you. Good morning. And this was on account of both higher traffic also and addition of the project. If we compare with the November, we declare numbers on a monthly basis. In the November 2023, the growth was around 20%. And that has increased 26% in December 23. So that is only because of the increase in the traffic. And in December 23, we have observed around 26% growth as compared to December 2022.
Addition is coming, how much growth has come largely because of new, and how much growth has happened to existing? Can you be specific with the number here?
Yes, so then if I will compare the growth in the December 23, the growth was 26% and November was only 20%. So 6% was growth on account of the volume in December alone. So that was the kind of 6.5% kind of volume growth we have witnessed across the portfolio.
Right. But Anil, are you also expecting any hike in toll rates from NHAI for the new fiscal?
So typically, most of the NHAI projects are linked with 3% fixed plus 40% of WPI, and rate revision happens on 1st of April every year. So 1st of April this year also will have a tariff revision as done in the various years in the past.
Tell me, what's the current order book looking like, and what are the orders that you have in the pipeline?
The current order book, including O&M, is roughly 33,000 crores. Out of that, 10,000 crores will be executed over the period of 2.5 years. That includes the EPC order book and the O&M order book, which is executable over the period of 2.5 years. And now coming to the new order book, as we spoken last time, now there is shift in the mode of award. And most of the project, as against 5 to 7% projects on BOT mode earlier years, now that has changing significantly, and 40 to 50% will be on a BOT basis. And the government on the NHAI website, there is almost 20 to 25,000 worth of project is already to be bidded out on BOT basis in next couple of months. Secondly, we have unique proposition as far as BOT projects are concerned. We have private InvIT in place where IRB has 51% stake and Government of Singapore has a 49% stake. So that reduces our equity contribution. If the project typically funded 70-30 debt equity, out of that 30% equity, we have to infuse only 15% as equity. And we generate all the EPC and O&M of these projects are executed by IRB, and we generate healthy margin of around 22 to 23% on these projects. And our equity portion can be contributed out of the margin itself. So then we historically also we were eyeing for the more BOT and TOT, and now considering we have a lean balance sheet, we will the shift of the government to for the more BOT project will definitely help the company.
Okay, fair enough, Mr. Yadav. Morning. So what about the pace of ordering? Because I understand pre-elections, it generally slows down. Is that something that you're witnessing right now? Will that impact your order inflow target that you spoke of?
I think your observation is correct. And there has been slowdown in terms of award as far as EPC and the HAM project is concerned. And this is not because of the election. It's because of there is restriction on borrowing of the NHAI. And the government focus is more on private participation. And we are going to see major shift from the EPC and HAM to BOT and TOT, and which we have already witnessed in this financial year. And going forward, also it will be predominantly more of BOT and TOT. And the player who has lean balance sheet will definitely benefit out of this change of the shift of the award activity. And I think there is sufficient number of projects on a BOT basis to be bidded out in next couple of months.
All right, really appreciate your time. Thank you for joining us. Markets, what do we have? A green, green and green. Bank Nifty, Nifty, Sensex. So it's not the brute force of liquidity and sentiment are two things which can weigh the markets differently. You're going back lower point at the resistance, you're bouncing back. You're not doing anything special, but that does not mean markets will go down. Just because you expect markets to come down, they're not going to come down. Markets are a very complex thing in the short term. There is sentiment, there are flows, there are technicals, and then there are global cues. All that factor put together, I guess it's easy to understand that momentum is not there on the upside, on the downside. Downside is limited, and you want to be buyer on bad days, and you do not want to chase the momentum like you did in October to December. That is a big differentiating strategy, if you frankly ask me. All right, gives me great pleasure now to bring on board Mr. Ashok Tyagi, whole-time director with the DLF. Tyagi Saab, good morning.
Good morning, sir.
70 to 100 crore is what you've raised in your new project in less than 72 hours.
That is correct.
Is it true?
No, it is true. We made an official stock exchange release also now. This was a project just off the southern periphery road in Gurgaon, and it's a relatively newer geography for us. And we launched this project, Privana South, about 1,100 odd apartments costing about 7 crores each. And it's true that it all got sold in 72 hours.
What was the average price?
And one more thing, Nikunj,
yes,
is
please.
that this time, unlike the industry practice, we did not take a booking amount of 5 lakhs or 10 lakhs. We actually upped the booking amount to 50 lakhs to sort of filter away the non-serious investors. And we still, after the allotment, we still have a wait list of people who are unhappy with us that they did not get the allotment.
What is the average price of that area, and at what average price you've sold?
So we've sold at a pricing of about 18,000 rupees per square foot saleable, which is about 7 crores per unit for a 4-bedroom, 7-quarter unit, in that sense. So it's a pretty generous unit. I mean, we do believe that the price point at which we have sold is at least 20% higher than the price point that we ourselves were expecting even, say, about 3 months back. And I think two pieces have contributed. Obviously, the DLF brand and the fact that that in that price point, the offerings from credible developers have tended to be sort of, very narrow. And B, I think infrastructurally, that area of Gurgaon has really improved and is coming up even further. In fact, just about a few hundred meters from this, we have the new office complex that we built up for American Express coming up. So I think that area overall is possibly one area where, hopefully there should be future growth of, within this Gurgaon, at least in this price segment.
How does one know that the interest what you've got, these are genuine buyers or these are investors who may just be looking at a flip?
So, Nikunj, here, the reason we easily put the price point, the upfront deposit at 50 lakhs, which frankly is unheard of in this segment, was to ensure that even if somebody is buying a second home or a third home, he or she is somebody who is relatively serious and is not looking at investing 10 lakhs and in 6 months flipping it out. The second point that we did also was that we restricted an allotment to 1 unit per family. So in fact, even some of my close friends who wanted 2 units, were denied the second unit because we were restricted to 1 unit per family. And to ensure again that there is not a clustering of speculators here. So I think it's a combination of end users, NRIs, and I'd say serious investors.
Mr. Tyagi, stay on with us. We have some visuals that are playing out live on your screens. That's the vibrant Gujarat summit that is taking place. Prime Minister Narendra Modi has just arrived to inaugurate the 10th edition in Gandhinagar, and alongside him are several global leaders, notable among them United Arab Emirates President Mohammed bin Zayed Al Nahyan, who is in attendance of the event. Do remember that this is the 10th edition. It has been envisioned under the leadership of Prime Minister Narendra Modi, and the theme for this year is the gateway to the future. Lots of big corporate voices, companies, partner countries as well are participating in the summit this year. We will be cutting across and getting you all the tidbits as and when they unfold. Apologies for that, Mr. Tyagi, but to get right back to our discussion then, and Given that we also have the fact that you've turned net cash positive in Q2 after several years, give us a sense as to whether or not you will be able to maintain the net zero status going ahead as well in light of the kind of launches that you have scheduled.
No, I think so. Clearly, we do believe that we will continue to generate free cash flow from operations on a consistent and a sustained basis. And I think that number, as we have indicated, should be a number between 500 to 1,000 crores on a quarterly basis, depending on, of course, the exact collection trajectory in a particular quarter. We've also indicated that our future utilization of this cash will be obviously split up between shareholder returns and between investing in growth, in terms of investing, in either interesting land parcels that come our way or interesting projects that come our way. But we are going to be extremely selective. But from an operations standpoint, I think clearly we are looking at a sustainable free cash flow coming up quarter on quarter now.
Now that you're beating your own internal estimates, both in terms of demand, pricing, what happens? I mean, for a company which I remember 10 years ago, we were asking, how will you repay debt? It's so nice if I'm saying that, would you be paying dividends out?
Sir, dividends we will pay dividends out.
Such a nice feeling. No, I mean, 10 साल पहले लोग बोलते थे debt का क्या होगा? Now I'm asking you, dividend कितना दोगे?
So clearly, I mean, the free cash flow that we generate, and I think it's right that it's only been a couple of quarters that we have now come in the positive cash surplus trajectory. We had a debt mountain which significantly we had reduced in 2017 with the GIC transaction, then to some degree with the QIP in 19, and the rest is all been done through operational flows. And I think the future cash flows should hopefully be split across, as I said, growth and dividend.
If you look at NCR region where DLF's presence is there in Gurgaon, but if we look at what is happening in Noida, what the UP government is doing, they are also now trying to start a lot of stuck projects. That's what the government of Uttar Pradesh is trying to do, and other state governments are doing the same. Could there be a situation that a lot of projects which got stuck, a lot of development projects which got stalled because of RERA and because the builder had their own cash flow issues, that supply could hit the market in 2-3 years, and that could curb the property appreciation and the demand?
So, in all fairness, Nikunj, a large chunk of the Noida projects which were stuck are projects which have been stuck in a brownfield zone. That means that customer commitments have been made. And I think the biggest challenge, which I think the UP government is trying very manfully now to solve for, is to see that the customer commitments are eventually fulfilled and the people who had put in their hard-earned money in those projects actually get a unit at the end of it all. So I think the first tranche of this cleanup, as and when it gets completed, would really be in terms of delivering those sold but half-constructed apartments to eventually in a completed state to the customers. At some stage, obviously, this will lead to a cleaner supply also in the market, but I think that possibly is still maybe a couple of years away. I mean, Noida obviously is a very interesting geography. It's just that I think we haven't yet been able to get the right residential plot of land there to do a major development. But Noida continues to be an interesting geography, and a lot of Noida builders, unfortunately, are no longer in a strong position.
I asked this to Abhishek Lodha of Macrotech, and I'm going to ask you the same question. I said, how do you see property prices now moving? And his answer was very simple, that we will not increase prices and our price hikes would be in line with the wage growth. Can I expect a similar kind of an move from you, that you will increase prices only in line with the wage growth?
So my view is that given the fact that we work significantly in the premium luxury and super luxury market, there would obviously not be any mindless price increases. That is fair. But the fact is that as the demand continues to strengthen for the more credible brands, be it Lodha or be it us, I think there will be an upward movement in pricing, at least to the extent of offsetting inflation, not just wages, but also the material commodity inflation. So clearly there should be no dilutive effect of inflation on the products. And right now, it's a fact that the major developers are also benefiting from a slight constriction in supply because a lot of the mid-sized developers had gone out of business. As some of them hopefully begin coming back, I think this would lead to some moderation. But I think there would continue to be a slightly upward bias in the prices. But I think the key is not to ensure that it doesn't hit a rate where it sort of makes affordability a challenge in the hands of the people who are buying it.
Affordability is not a challenge. A house of 7 crore, almost in the new outskirts of Gurgaon. I mean, I can compare and say that Bombay क्या बुरा है फिर? 7 करोड़ में तो यहाँ घर मिल जाता है.
Bombay बिल्कुल बुरा नहीं है.
Is it really affordable now? 7 crore, these are numbers which are unheard of.
So I'll tell you honestly, so affordability is obviously driven by the earning capacity of the person who is investing. If you see, and I'm talking predominantly of NCR because my knowledge of the balance markets is not as strong. The fact is that the only segment which has actually had a stress in the last, I'd say, few quarters is the lower end of the market. I'd say the 50 to 60 lakhs piece, because that's where be it the higher interest rates or some of the challenges have hit the prospective customers. I mean, for people who are buying products in the 2-3 crore plus category, I think clearly there is a great degree of optimism that is there in the market. Real estate as a credible investment, avenue has come back, especially from credible developers. And I think overall there is a sense of optimism, which is now almost 2 years, 2 years plus, that's been continuing. And frankly, given the fact that the economy overall continues to be on a strong curve, I think at least the premium luxury products, these would continue to have a strong demand curve.
If I look at the last 15-20 years or maybe more, real estate cycle is normally a 5 to 7 year cycle. 5 to 7 years is what the real estate cycle is, and then it gets into a 2-3 year kind of a downtrend. Can I say that this cycle perhaps is going to extend itself beyond 7 years and we are still in an early stage of a real estate revival?
So, I mean, in all fairness, I think we can talk facts. Yes, you're right that across a 7 to 10 year cycle, that has been the cyclicity in the past. We are currently, I'd say, about 3 years in the third year of this upcycle. So honestly, I'm not a statistician or a macroeconomist to predict for how long this will last. But I do believe that most macroeconomic indicators today, lead to the fact that this should sustain at least for the next 3 to 4 years for sure. And then I think it will be a function of how the macroeconomy functions, whether there's some true macro event that happens which tends to slow it down, or something something foolish that the industry itself does or something. But I do believe that you're right, we are still in the third year of this good cycle, and hopefully we continue to see a strengthening of the demand curve as we go forward.
Guidance for FY24, 13,000 crore and launches worth 19,700 crore. If I add just 2 projects, including the project which gave you 7,200 crore, you are likely to beat your guidance hands down.
No. So we have met the full year guidance by the end of Q3. That's a statement of fact.
In Q4 then. And what happens in FY25 then? That's a relevant question, because your exit for FY24 would be a higher number.
So in all fairness, Nikunj, we have a launch pipeline. So there are the next phases of the Privana piece, because the Privana overall is a 116-acre township, of which only the first 25 acres has been sort of offered for sale right now. There would be a super luxury project coming up on the Golf Course Road next year. There would be launches next year, hopefully in Mumbai and in Goa and possibly in Chennai, as well as in Chandigarh. So I think the launch pipeline is very robust. I am not right now venturing into the numerical guidance for fiscal 25, but I think it's safe to assume that the fiscal 24 will end at a number higher than 13,000 for sure. By how much, I think that's something that we are still working. And in fact, as our joint managing director in the sales had said a couple of days earlier, we are also seeing if some of the launches that we had originally scheduled in in the next fiscal can be advanced to Q4. May not happen given the approval cycles. But I think clearly we continue to be on a healthy path of I'd say the mid-teens from a sales strategy standpoint for fiscal 25 as well.
How many billion plus launches or launches of the size of Privana are lined up in FY25?
Yes,
1,
of
2,
course.
3. How many? 1, 2, 3.
So at least 2 major launches in Gurgaon are lined up.
Okay.
One launch is lined up in Mumbai, which obviously is a smaller launch, about 2,000 crores. One launch is lined up in Goa, and one launch should hopefully be lined up in Chennai. The approvals are still in the final stages. So I think clearly, and there will be at least one small launch in the Tri-City of Chandigarh as well. So I think we have the launch pipeline pretty well covered.
Question, you just mentioned that your friends who approached you for 2 houses, you only gave them 1. But have you promised them more houses than the new launches?
No. So obviously, we have a wait list now. So whenever the next phase launches, if they're still interested, they'll be most welcome.
Coming to Delhi, and Delhi real estate companies are going to Gurgaon. What is happening?
That is correct. That the Gurgaon piece is the one which is right now the magnet from a higher growth curve. The projects in Delhi are doing okay, doing well. But I think the sort of demand and price curve that we are seeing in Gurgaon, I think Delhi is still slightly on the more conservative side. So I think let's see how the Delhi market also evolves. There are a couple of major launches lined up in Delhi market also in the couple of years, not only by us but by a couple of our competitors as well. And let's see how those pan out. But we are our one midtown project in Delhi, which was in central Delhi, which is the JV that we had with GIC, has actually done pretty well. There are subsequent phases of that which will come in the market in the next few years. I think the next one may not come in the fiscal 25, but in the fiscal afterwards, given the approval timelines in Delhi. But I think Delhi also over time, I think, should begin catching up from Gurgaon, with Gurgaon in this entire. Condo living in Delhi is a relatively less. I mean, it's a less populated concept as compared to Gurgaon, and I think that's where I think the market's gradually beginning to move now. Delhi traditionally used to be, independent flat, DDA flats, independent floors, or those kotis, and the group condo high rise. I think really our Capital Greens project and the Commonwealth Games project were really the only two developments of size and scale in that. And gradually now we are seeing more developers beginning to come up on that.
Tyagi Saab, always a pleasure to have you. Thank you for joining us.
Thank you, sir.
And good luck for 2024. 782 rupees. Where did DLF plunge at the peak of COVID? I think less than 300, I remember. 2020, May or June. Don't want to even look at some of those prices. I mean, what markets went through during COVID? I just take the clock back and I would say, OMG, I mean, these actually happened. There's not once upon a time.
The best opportunity perhaps that we'll see in our lifetimes.
That's market.
You never know actually, but yeah.
See, every 10 years, you see the history of markets. And last 25 years I've seen and I've studied the history of the market. You will get 140 to 50% correction. For example, 9/11 happened. Once
2008
crisis, yeah. 2020. Every 10 years, you will get one opportunity in the market where the index will fall 40 to 60%. Every 3 years, you will get one chance where the markets will fall 25 to 30%. And every 5 years, you will get it twice. That's how markets have moved. For example, 2008 crisis, when we recovered, you had taper tantrum. When that recovered, there came the economic slowdown. 2020, COVID. After that, Ukraine crisis. I don't know what's going to happen in future, but you get something which you don't know. Because if markets know what is coming, the prices would adjust. Markets will always adjust to something what is unknown. And that is where you get a shock wave and price dislocation happens.
Opportunity, yeah.
Yeah. When price dislocation happens and reality is different, that's the time you need to be a buyer.
Yeah, absolutely. Okay, let's bet on what actually to be putting your money into. And clearly, it's all across real estate, infrastructure. That really seems to be the theme. So let me welcome on board Abhishek Kapoor, Group CEO at Purvankara, joining in on the show right now. Abhishek, hi, morning. Great to have you on the show. Just help us understand, we were just chatting with the management of DLF as well, and I'm sure you got a piece of that conversation. How's business shaping up for you at your end?
Hello, very good morning and happy new year to all of you guys. A bit late, but nevertheless, it's definitely a good and a happy new year. So it's looking pretty good. The numbers have stacked up well for the last quarter for us. We grew by our pre-sales grew by about 56% to 1,241 crores, and the best part was the collections, which almost are close to 1,000 crores in the last quarter. We are at 941 crores. And for the three quarters together, 9 months, we were almost close to 4,000 crores versus 2,100 crores last year, 89% growth. So, yeah, we're pretty happy with what's happening. And I think looking forward to the launches coming up in the coming quarter.
Give us a sense of what exactly is planned. We were just chatting with Mr. Ashok Tyagi that the Mumbai players are moving to New Delhi and the New Delhi ones are coming to Mumbai. How are you looking at diversifying and what's the project pipeline like?
Look, our presence currently is very significant in the south of India, but we have expanded our presence already in the west. We are increasingly doing acquisitions in the western region between Mumbai and Pune. I think next year will be a inflection year for us in the western region. We will see more launches coming in there. And our thought process really currently is to look at five major cities, which is Bangalore, Hyderabad, Chennai, Mumbai, and Pune, other than the other five cities that we're already present in. So I think we will continue to expand. Of course, North is something which is always on the horizon. We will continue to look at our entry at some point in time.
Fair enough. Let's also get in a sense as then what the outlook is when it comes to the foray that the company has made when it comes to redevelopment as well. Can you take us through what kind of GDV potential you're targeting?
Look, we've just done the first acquisition, which has got 1,500 plus crores of GDV. But it doesn't stop there. We have a robust pipeline of projects which we are working upon. And I think some more announcements of new acquisitions will happen in this quarter, wherein we're working on multiple projects across regions, south and west. Redevelopment, of course, in Mumbai is going to be one of our mainstay. And we intend to actively participate and pursue opportunities there. And I think you will see a lot more coming in next 2 quarters there.
The average price realization on year is down about 2%. Just wanted to understand, given that it has been pretty strong with the collections, the customer collections across the board, what the outlook is when it comes to the price realization down the line and trends?
Look, this down of about 2% is more on the back of inventory mix. But overall, average realization between each brand, which is Purvankara, Provident, and Purva Land, the general realization has gone up over the last 8 quarters, I would say. What we see is more micro market and project driven price increases. There are different micro markets which behave differently and demand supply situation there. And of course, the maturity of the project decides what kind of pricing and the price appreciation that you look at. But normally from launch to completion, you typically look at anywhere between 50 and 70% increase in price. And I think that trend will continue as far as the real estate sector is concerned. But if you look at, the overall average increase in the price, because this increase I'm talking about between 4 and 5 years, if you look at average increase, I think it will stay somewhere in high single digits. I would expect the industry to be at about 8 to 9%, which is pretty much akin to inflation plus maybe 3% or so on an average. But I think project to project, micro market to micro market, you will see different increases in prices. But the good part is, I think as an industry, developers have not gone, over the top and increased prices, but they are chasing volumes. And I think that's good and healthy for both the consumers and the developing community.
Right. The other thing I wanted to understand was where your net debt as of now, as we understand, stands at about 1,990 odd crore rupees, right? This was as of Q2 end, obviously. What's the debt retirement plan?
Look, from our point of view, we want to keep the debt levels at similar levels. But what we want to do, which we are successfully now demonstrating, is increase our business. But if you look at another metric, which is basically debt per square foot of area under development, that has dropped by more than 50% over last 2.5 years, so 3 years time frame. I think that trend will definitely continue, and we will continue to add, to our bottom line and the EBITDA numbers. But having said that, I think debt is more a factor of the volume of business you do, and our focus is really to increase the volume. So we would expect the debt to be at similar levels because we will do a lot of acquisitions. This is pretty much all self-retiring debt, other than the commercial debt, which is largely going into an asset creation. So natural course of the business, we will retire a lot of debt. Having said that, we will continue to acquire, and therefore the cycle continues. And focus really will be to ensure that we don't compromise growth for the debt or any other business. We have a healthy balance between debt and the business that we are doing.
I know you just touched upon growing off EBITDA. Any projections in mind or any targets that you have in mind?
Look, our goal is really to stay with the 30% target, EBITDA target, and continue to sustain that on an average. Now, this varies between Provident, Purvankara, and Purvaland. I would expect us to maintain that, given that construction costs, land costs, etc., approval costs. So I think we will definitely maintain a 30% healthy margin as far as the EBITDA numbers are concerned.
Appreciate your time. Thank you for giving us a lot more clarity on Purvankara's business and what the road ahead looks like. All right, with news that we're at 21,500.